You're a real estate investor or a business owner, and you're sick and tired of hearing all about these real estate investors who are living off the cash flow from all of their real estate investments, yet you're sitting there scratching your head going, how in the world are they doing this without owning dozens or hundreds of properties? The truth is, this is really hard to do. So in this video, I'm going to be covering both real estate acquisition as well as business acquisition and discussing the different ways you can do both of these things and also how you're going to be able to do them in conjunction with one another in order to maximize not only your wealth creation, but also your cash flow. I'm James Masotti, a real estate investor, the owner of Our Team Accounting and Crystal Clear Property Management. And on this channel, I am passionate about helping business owners and entrepreneurs achieve their personal and professional goals through intentional financial planning. Let's go ahead and dive right into today's video. First, we're going to be going over why real estate investing and business acquisitions work so well together. The first piece of this is the fact that businesses are really known for being great cash generators. If you're running your business in a profitable way, you are generating extra cash at the end of every month and at the end of every year that if you're growing a business or you've got a healthy business that's sustained, it's hopefully more than what you need actually to live the lifestyle that you have. And so this really puts you into a spot where you can start thinking about how to create longer term wealth. And that's really the part where real estate acquisitions come into play, because real estate can be hard to cash flow, but you have the really great benefits of it appreciating over time and really increasing in value at a rate faster than what most businesses will be valued at. One of the great things about having a business is that you're going to be able to use the cash flow that's being generated by that in order to fund your real estate acquisitions. At the same time, though, you're also going to be able to use the equity that you have in your real estate portfolio in order to be able to fund business acquisitions by leveraging that equity in order to secure business loans that oftentimes don't have as much collateral to them. And the banks are going to be a lot happier when you have assets to back up the loans that they're giving you to buy businesses. Some other reasons that these two things can really work hand in hand with each other is the fact that while real estate is difficult to cash flow in the short term, it is a great long-term cash generating aspect because your mortgage rates are often fixed. And as your loan balances get paid down, your rents are often increasing. And so you start to create a delta the longer you hold your real estate that you have this additional cash flow coming in. Another great aspect to these things happening hand in hand is simply the fact that so many businesses actually need real estate in order to operate. So whether you have a manufacturing or distribution business where you have acquired the building that your business is operating out of, or maybe you've got more of like a retail establishment and you have an opportunity to buy the strip center where your real estate is or your business is based, these are great plays to be able to take advantage of the long-term appreciation of the real estate while also being able to have more control over where your rent is going. And instead of paying your rent to somebody else, you can ultimately be paying rent for your business to yourself in order to really maximize both the benefits of your business operations, but also the value of the real estate that you're operating out of. The second reason that these two things work so well together is the fact that you can use your real estate in order to help fund your business acquisition. One of the things that real estate is probably best known for is the fact that over a long period of time, it's generally been known to appreciate in value. At the same point in time, you're making payments against your loan, and so your loan balance is going down. And this is what creates equity that's available in your real estate portfolio. And when you're going and doing a business acquisition and you have the net worth associated with a hard asset like real estate, this is often very attractive to banks when they're looking at underwriting a business acquisition because you can guarantee that loan with the equity that you have in your real estate. The longer that you've held your real estate as well, you've hopefully not only had the pay down, but you've also seen your rents start to go up. When you have this available, not only liquidity in your portfolio, but you also have more ability to have a debt coverage ratio, which is basically the amount of income coming in from the properties compared to the payment that you have to make on that particular mortgage. That creates an opportunity to either do a cash out refinance on the properties up to an acceptable debt coverage level for the banks, or you can get a line of credit across your properties in order to also create kind of some what we would call dry powder, so that when opportunities present themselves, you're able to utilize that equity that you have in your properties, but not have to worry too much about being able to make payments on that, because the income that you're receiving in those increased rents from the properties should be able to cover the often what are only interest only payments on that line of credit as part of all of that. Now, the flip side to this is going to be you have an existing business and you want to start utilizing the income from that business in order to purchase real estate. One of the great things about real estate is that you can purchase it with leverage. And oftentimes you're able to do that with 20% down using conventional purchase methods. There's a lot more creative methods where you maybe don't have to come out of pocket at all. But once you've established what your living expenses are, if your business is experiencing growth and you're having net income that exceeds what your living expenses are, sure, you can buy more boats and more cars and more vacation homes, but you also have the ability to grow your longer term wealth, which is a lot of times more easy to pass on than a business. And so being able to take the cash flow from your business and convert that into another asset like real estate is a really, really strong option to not only grow your own wealth, but if generational wealth and having something that you can pass on is something that you're considering, is a really great way to be able to do that in a very tax advantaged way. If you're interested in learning a little bit more about my background with real estate, go ahead and click the link for the video on your screen right now, where I go more in depth about my journey in real estate up to this point. The third way that investing in real estate and buying businesses go hand in hand is with utilizing products like the SBA 7A and 504 loan products. The lending guidelines for both of these products are regularly changing, but as of the recording of this video in January of 2025, the SBA 7A loan product can go up to 100% if you are doing what the SBA refers to as an expansion loan. So if you have an existing business and you are buying another business that uses the same NAICS code, then you can actually get potentially 100% financing if the bank you're working with offers that. If they don't, though, you can go ahead and get 90% financing on that. And the 10% equity that you have to come to the table with is possible to do with either a seller's note, depending on how you structure that and whether the seller is willing to sit in standby and not get payments for a certain period of time. But even if they're not, you don't have to use your own equity. You can actually use equity from investors who wouldn't have to personally guarantee the loan if they don't own more than 20% of the company. Now, there may be some reasons that you don't want to use the SBA 7A loan product to purchase the real estate. If that's the case, then there is a product called the 504, which is an SBA product for being able to buy or expand your existing real estate within your business context. And there are some reasons why you may want to use the 504 instead of the 7A. And one of the main reasons behind that, it has to do with the levels that the SBA will guarantee the different loan products. And with the 504, you can get a larger loan. And if your business acquisition is a larger business that comes with a higher purchase price, they only guarantee, again, as of the recording of this, up to $5 million. And so if you're in an area where the real estate's more expensive, or you're thinking that you may want to do future acquisitions, then you may not want to include the real estate with the 7A product, and you may want to instead choose to use the 504 loan product to do your acquisition, which then still leaves, resources, so to speak, available to do additional acquisitions under the 7A and the guarantee limits that are there. You can also get a little bit more creative if you're buying a business that also has real estate, because in some scenarios, the business owner may own the real estate outright, and they may be willing to sell or finance the property to you, as long as you're doing a cash purchase or a financed purchase where they are getting all cash for the purchase of their business. They may be willing to sell or finance the property to you, which gives them a lot of tax advantages as well as some additional income for the years that you're making those payments. If, however, the business owner is not wanting to sell or finance, then what you could also do is negotiate a leaseback with a first right of refusal, or maybe some performance hurdles where you have the opportunity to purchase the real estate. But while purchasing the real estate can be really good, you also need to look at, the strategic component to the real estate. And If the property is too small or it's in an area and you want to be able to relocate the business, if you're outgrowing the space, then it may actually be beneficial not to take on that real estate if the building is also very purpose built for what you need it for. And so if you ever decided to leave, it would be very expensive to either retrofit or utilize that real estate for some other purpose. The fourth reason that buying businesses and real estate go hand in hand with each other is the fact that there's a lot of types of businesses that really go hand in hand with owning their real estate. Think manufacturing, think distribution, auto repair shops. These are all examples where the real estate is really an underpinning of the ability to run the business. Rather than having to pay rent to somebody else where you're not in control of the expenses, there's a great opportunity to take on all of that together and really control your own destiny. And the simple fact of the matter is, real estate is generally considered to be a safer investment class than businesses are. And so as long as when you're underwriting the business, it has strong cash flows in order to be able to cover all of its debt service and pay a fair market rent, the multiple that you can get on the real estate is actually far greater oftentimes than the multiple that you're going to be able to sell the business for. If you do own the real estate for your business, then you're probably familiar with the fact that commercial leases are not like residential leases, and they tend to be longer in term. For more like smaller office spaces or like strip malls and things like that, it can be 5 years. But if you're talking about larger industrial or commercial spaces, then the leases can sometimes go as high as 10 years. And so when you have that kind of, credit-worthy, buyers that have strong financial statements, reliably giving you rent every month, it's a lot better than if you simply owned a residential property and you're not sure whether the quality of the tenant's income is going to be able to pay your rent every single month. Doing your company's accounting on your own can be overwhelming and time-consuming when you're trying to run your business at the same time. If you're interested in learning more information about our do-it-yourself and done-with-you group coaching programs, or if you're interested in taking your services to the next level with our fully outsourced accounting solutions, getting help with implementing Profit First, or even fractional CFO services, go ahead and scan the QR code on your screen or click the link in the description below to find out more about these programs and how we can help support you. And the fifth reason that we should be looking at taking, buying businesses and real estate hand in hand is the tax synergies and the tax advantages that come along from combining these two strategies. And so while I'm going to go over these things, it is absolutely important to caveat that I am not a tax expert. These are things that I know many people have done. And like always, the caveat is your situation may be different. So if you're interested in exploring whether or not any of these strategies would work for you, it's very important that you talk to your tax planning, tax strategy professional ahead of time before you execute your plan in order to make sure that these will actually work for you. The first thing is going to be depreciation and cost segregation. The depreciation is the normal depreciation that you're allowed to take according to the IRS. For example, in a single family home, right, it's 27 and a half years, but that changes when you get into industrial and commercial properties. And, but you get to take that benefit. Now, what you have to be careful is because the depreciation benefits and the passive losses that you can take from that are limited to a certain amount and start to phase out if you're over certain income levels. One of the things that you can do, though, if it does benefit you and the structure that you have in place, is what's called a cost segregation study. And what this basically does is rather than take the standard deduction that the IRS allows you to do, you can spend a bunch of money to hire professionals to basically go into your property and break out all of the different components of that property and depreciate them over their specific life cycles. And what this can do is it may allow you to accelerate the depreciation that you're taking and depreciate that property over maybe a 10-year period rather than a 27.5-year period. Using the traditional home purchase, you're probably not going to do a cost segregation on a standard home, but just understanding that you could potentially accelerate your depreciation and therefore your tax advantages a lot more significantly in the near term if you go about that route. Another one of the advantages that you may be able to take advantage of is what's called a 1031 exchange. And a 1031, or what sometimes is referred to as a like-kind exchange, is what allows you to sell one asset and then use the proceeds from the sale of that asset to buy another asset that is in a very similar asset class. So in this example, if you own the real estate that your business is in, and you do eventually down the road decide to sell your business and the real estate along with it, you could actually take the proceeds of that and decide to go buy a larger piece of real estate that maybe is going to appreciate better or have stronger cash flows, or just, achieve your post-business sale goals in a better way than what maybe the property you had was going to do. And that's why you decided, rather than holding on to the property and leasing it back to the business buyer, that you're actually just going to sell everything. And in order to minimize the hit that you're going to take on your capital gains tax, you can do that 1031 exchange with the real estate. Again, something to talk through with your tax professional is whether or not you want to be buying your real estate within the same LLC that your business is in, or if that should be a separate LLC. You want to have that conversation with your tax professional because you want to understand the tax implications of those two things back and forth. But I also encourage you to have a conversation with your attorney in order to make sure that you're covering yourself from a legal exposure perspective as well. A lot of times from a tax perspective, there's not necessarily benefits to separating the entities, but there is from a legal exposure perspective. And so you may end up having to pay a little bit more in your tax filing or your accounting fees by keeping those things separate. But it's really going to protect the wealth that you're creating in the property from being something that can be gone after in a lawsuit if your business were to be sued, for example. So now that we've kind of gone over a whole bunch of these things, I thought it would be good to give you a couple of examples of folks that I know and who have kind of utilized different components of this strategy in order to not only grow their businesses, but their real estate portfolios as well. And so one of them is somebody who was a real estate investor, and they started buying laundromats. And so these laundromats are in and of themselves businesses that are going to generate cash flow from whether you're selling monthly subscriptions or you just have coin operated machines, or however you choose to operate that business. And if you're able to operate that business in a positive cash flowing manner, like my friend has done, then you're able to then take those proceeds and you're able to look for additional laundromats and additional real estate that you can buy, whether it's existing laundromats that have real estate behind them, or maybe it's just real estate that's in a really great location that you can then do an additional laundromat, and you can continue this process and start to create a multi-location laundromat operation. Another example would be going in and buying a distressed manufacturing or distribution operation and being able to buy that basically for the value of the real estate itself. And I have a friend who went about and did this process, and over the last couple of years has done a great job of turning the business around, and it's now generating some really great cash flows. And that money is now being reinvested back into additional real estate acquisitions. And so not only did they get real estate as part of the purchase, but now that the business is generating profits, they're able to go and buy additional real estate. In another example, you have somebody who has acquired a home improvement business, a home remodeling business. And basically they're able to leverage the fact that they're getting materials at discounts and the fact that they have a labor force that is skilled in doing the rehabs and renovations to be able to go out and purchase properties that are in need of repair and renovation. And they're able to basically do those at a lower price point, so that when they are able to convert those properties into permanent rental properties, then they're able to set those up, in a very cost-effective manner, because they're not having to, pay all the markup to outside contractors, because they have the resources in-house to be able to do that. It also gives them the ability to take advantage of flipping properties, and sometimes just because of the networks that you've built in that scenario, you actually get line of sight to building relationships with other investors, or being made aware when properties are in disrepair. You can actually make offers to purchase the properties outright and take advantage of doing the repairs, and then the sale or the refinance and the rental of those becoming something that you can benefit from. So if you're a business owner looking to get started in real estate investing and you're interested to learn about the benefits, risks, and the simple steps that you can take to buy your first property, go ahead and click the video right here on your screen, and I will see you over there.